In today's video, I will talk about simple price action reading and what I find to be the optimal tools of trading with charts. I say that because there are countless ways of trading with price charts, and most of them are unreliable, unfortunately. That's because traders have to deal with the problem of trade location, which means that it's not simply a matter of finding out the current trend of the market. You have to get the timing of the market correctly as well, and that's where the real challenge begins. Determining the trend of the market is not so difficult, but the trend is a loosely defined idea. In order to trade effectively, we must get more surgical. When it comes to trading with charts, I believe that the best alternative is to align contextual price reading with tools that form an immediate barrier for price, like lines for example. I would avoid trading with indicators like moving averages and Bollinger Bands because they have the problem of lag, which I'll talk about in a future video. When we trade with simple lines, we completely eliminate this problem of lag, and we are left with a simpler and more reliable analysis. However, it's not like such analysis comes without challenges. In this 4-hour chart of the Euro-USD, we have a situation where price is creating higher highs and higher lows in the major flow dimension of the market. The question here is how far down the sellers will retrace the market until buyers pick it up again. That's usually highlighted by the demand zone. However, very much like the notion of market trend, supply and demand zones are also loosely defined. There are correct ways of drawing such zones, but sometimes price will not respect them. What happens is that price can fall short of or surpass these zones without even reacting to them. This is the sort of thing that price action traders must be able to anticipate. Obviously, you don't have to guess what's going to happen, but you need to pay attention to the fact that this not only can, but it will happen occasionally, so you have to be prepared for it. The trick here is to watch how price reacts to the key areas of the supply and demand zones, assuming you will get there in the first place. That would be the easy part of this problem. The other part of the problem, which is far trickier, is that price might hit a significant barrier before retracing all the way down to the demand zone. This is more difficult because you have to find out which barrier is causing price to stop. An experienced price action trader will often say that price leaves subtle clues that only the trained eye is able to pick up in real time. This is what separates a good trader from a bad trader, and that makes sense because if these clues were obvious, everybody would be able to make money with them. One of the best tools there is to find out these non-obvious barriers is of course the Andrews pitchfork, which is one of the very few tools in technical analysis that actually has a scientific backbone to sustain it. The Andrews pitchfork highlights the specific geometric nature of recent price vectors, and is also grounded on Newtonian physics. If we ground a standard Andrews pitchfork on numbers 1, 2, and 3, we'll see that price is currently hitting the center line of the pitchfork, which would be a point of equilibrium. However, price hasn't been able to retrace back to the textbook demand zone. It's sometimes dangerous to trust the center line of the pitchfork by itself, especially when it's not correlating with the supply and demand zone. This is where the trader must make the decision of watching price action more closely. Let's increase the level of resolution in our analysis a little bit so you can have an idea about the kind of detail I'm referring to. If you pay attention to the lower wicks of the candles that touch the center line of the Andrews pitchfork, you'll notice that there is an appropriate reaction in there, meaning that buyer seems to be reacting to that line in some degree. Another detail we can visualize is by applying the modified version of the Andrews pitchfork, which simply brings the A-axis of the forex to the midpoint of the AB segment. There are reasons for this that I will not go into in this video, but know that this is not an arbitrary decision. Observe here that the center line of the modified Andrews pitchfork is also catching the same low from before. Now we have an upsloping line, which is stronger than a downsloping line when we are talking about a falling market. From this point on, we can watch what price does to see if it's going to respect this paradigm in the near future. So let's observe how price develops. Here we can conclude that price began walking sideways after it touched the central line of both pitchforks. That can mean that price will not retrace all the way back to the demand zone as it is expected by most traders most of the time. We can also see that price is now respecting the upsloping lower line of the modified pitchfork as it touched it again and reacted to the upside. Notice that there is a little story beginning to form here. Price went down to the center line of both pitchforks, started to drift away from the downsloping pitchfork, and is still trapped by the upsloping one. The remaining abstraction here is that price is in tune with these pitchforks. The fact that price touched the lower line of the modified pitchfork and reacted to it a second time means that we have the presence of buyers in that level, and we can think about a long trade opportunity considering all of this context. Please consider that there is a broader context here that goes beyond the simple observation of price touching a line. I say this because your first impulse will be to look for the times where price respected the pitchfork line while ignoring the overall context where it happened, which is a classic mistake. An entry trigger could be the next time price touches the lower line of the upsloping modified pitchfork. The stop could be logically placed below the low that reacted to both center lines in the first place. Even though this is not a textbook stop loss order placement, it makes sense that there should be a cushion of demand in the level to protect the entry in this trade. The target can be maintained at the optimal level of 1 to 3 risk-reward ratio for simplicity's sake. Let's advance price to see what happens. Here we can see how price touches the lower line of the modified Andrews pitchfork another time and takes off. A couple of things to notice here is that price will not always retrace all the way back to the textbook supply and demand zone because that would be too easy and predictable. The lesson is that you must keep an eye on the important levels that can be highlighted not only by the pitchfork, but by many other types of meaningful lines. The other detail is that before taking off, we can observe a frequency shift that highlights once again how the pitchfork has its roots in Newtonian physics. We can see how an overthrow on the lower line of the pitchfork causes an underthrow on the upper line of the pitchfork. Hopefully, you are able to see how there is more than meets the eye when it comes to price charts, and how there is order within chaos for those with a trained eye. If you want to learn how to trade using these techniques and many other techniques used by professionals, check out the courses I provide in the video description. If you like this sort of video and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel if you want to learn more. Thank you for watching, and I hope to see you in the next videos. Take care.